Hello everyone. In today's class, we will go through stock markets. Here, I will give you an overview about stock markets. As we know, for the enterprise or company, they would like to raise funds from the financial markets. How could they do that? Actually, they have three ways to raise funds from the financial market. The first way, they can issue stocks into the stock markets and raising funds from stockholders or investors. The second way is the company can issue the debt, corporate debt, and issue the corporate debt into the debt market and raise the fund, raising the fund from investors. The last way, if they want to raise funds from the market, actually they can borrow money from commercial banks or other financial institutions. Even they can use their retained earnings to transfer retained earnings for financing their project or their investment. So in today's class, I would like to introduce the first way, the most popular way to raise funds from investors. This way we call the stock market. Through the stock market, corporations or enterprises can issue stocks. So corporate stock serves a source of financing for firms, in addition to debt financing or retained earnings financing. And why the stock market is the popular financial market in the world? Because the stocks is the most popular financial tools for people. If you have your friends, you hear about your friends' investment or your families, you always hear about they invest money on stocks, not debt or mutual funds, right? The most popular financial tools is stocks. So in this chapter, we will focus on the stock markets. And in addition, the stock market can help enterprise to raise funds from investors. Also, the stock market have the secondary markets. The secondary stock markets are the most closely watched and reported of all financial security markets. And the stockholders, if they hold stocks, actually they have the legal owners or owner right of holding a corporation or enterprise. Here, I want to introduce several important features for stockholders. When they hold stocks, they have several features. The first one, if the stockholders hold the stocks of a company, actually they have the right or share their firm's profits through dividends after the payment of the interest to bondholders and the taxes. That means when the corporations or enterprises they earn the profit after they pay the payment to the interest or bondholders and pay the corporate taxes to government, and the left of the profit we call the net profit. Usually we will break down the net profit into parts. The first part we call retained earnings, right? Retained earnings means the firm, the enterprise will hold the profit for their future investment. And the other part we call the dividends. They will share the net profit to their shareholders or stockholders. And the second feature on holding the stocks is the stockholders have a residual claim on their firm's assets. And the third one, they also have the limited liability to debtor of the corporation. And the last one, if the stockholders, usually they have the voting rights. The voting right means they can elect the board of directors by using their voting right, right? So the next slide, I will show you the important features on holding stocks. Before we go through the features on holding stock here, I would like to share you the figure. The figure shows the market value of common stock outstanding in the US. As you can see, here we have 3 pie charts, right? The first pie chart represents in 1994, the market value of common stocks outstanding in the US. So as you can see, the 70% of market value of common stock outstanding by the type issuer, as you can see, is non-financial corporation business. The non-financial corporation business, the market value will account 76%, and the other type of issuer, such as the financial corporations, or rest of the world, as you can see, will account 24%. But in 2007, as you can see, the total value of market value of common stock outstanding in the US increases a lot, from 6.3 trillion to 26.4 trillion. Increase over 5 times, right? So relative to 1994, the market value of common stock outstanding in the US increases a lot. As you can see in second pie chart, the US non-financial corporation business will account 60%. The others account 40%. Okay, so the US financial corporation, the market value of common stock on US financial corporation will account very close to 20%. And in 2018, so as you can see, the total value, on the market value of common stocks outstanding in the US increases by over 2 times, almost over 2 times, from 26.4 trillion to 43 trillion. Okay, so in 2018, the US non-financial business corporations, the market value of common stock outstanding will account 60%, and the others also account very close to 40%. So from the 3 pie charts, we realize the market value of common stock outstanding increased a lot in the US financial markets. Now, here I would like to show you the important features on holding stocks. Actually, we can break down the stocks into parts. The first part we call common stocks. The other part we call preference stocks. Okay, so here I would like to show you 2 types of the corporation stocks. All public corporations issue common stock, but few companies issue preference stock. Why? They have very different features. Okay, for their different purposes, some corporations they would like to issue common stocks relative to preference stock, but the others will prefer to issue preference stock relative to common stocks. Why? I will show you the reason later. Okay, but here I would like to show you the important features on holding common stocks. Common stock is the fundamental ownership claim in public or private corporation. Many characteristics differentiate it from other types of the securities. So here I would like to show you the 4 important features on holding common stocks. The first one, discretionary dividend payments. The second one, residual claim status. The third one, limited liabilities. The last one, voting rights. I will show you the 4 features separately. Now, let's take a look at the dividends on holding common stocks. The companies would like to pay the dividends to stockholders. It depends on their dividend policies, right? So every year in the US is every quarter, they will hold the board meeting, right? In the board meeting, the board of directors will discuss the dividend policies, how much they will pay dividends to stockholders, how much they will become to the retained earnings? It depends on the dividend policies. So it depends on the board meeting and the dividend policies. That's why dividends are discretionary and are thus not guaranteed. If the company perform worse this year, or they will face the net profit is positive or zero, that means they will not have ability to pay the dividend to the stockholders, right? So this year or this quarter, the stockholders will gain zero dividend from the company, right? So it depends the dividend policy on this quarter or in this year, right? So that's why dividends are discretionary and are thus not guaranteed. So dividends represent the payment. The payment and the size of individuals are determined by board of directors of the issue fund. So that's why the issue fund, issue the stock market corporations, they will hold the board meetings every quarter or every year. In Taiwan, every year we will hold the board of directors meeting, right? Board meetings. But in the US, every quarter they will hold a meeting and discuss the dividend policies. Okay, and usually the dividend are taxed twice. Once at the firm level and once at the personal level. The same as the Taiwan. Taiwan, the case is similar to the US case. And due to the reasons, because may partially avoid the double taxing effect by holding stock in the growth firms, they will consider this issue or this reason. So usually the growth firms, they are considered to transfer their net profit into the retained earnings. They will not to pay dividends to the stockholders because maybe due to the tax issue. And here, in this slide, I would like to show you how to pay the dividends, how to calculate the return on holding stocks. Okay, stockholders, why they want to make payment or pay the price to holding the stocks. Okay, they want to invest money on stocks. The main purpose come from they want to gain the profit or share the profit from the company, from the issue company, right, or issuing firms. So here I would like to teach you how to calculate the actual return on holding stocks. Initially, the stockholder or investor, they buy the stocks from the stock market. They pay the initial price, right? And holding the stock for a time period. After over a time period, they sell the stocks. So how much they can gain the return on holding stocks? So here, I would like to break down the return on holding stock into parts. The first part, as you can see, is the capital gains on holding stocks. The second part is the dividends, dividend from the stocks, right? So here, as you can see, here we have several notations. I would like to introduce the several notations. The first one, PT. PT represents the stock price at the time T, okay, or the current stock price. And the DT represent the dividends, the period over time, okay. If the stockholders hold the stocks during the time period, they will gain the dividend on holding stocks, right? So the DT represent dividend period over time, and the PT less 1 or PT minus 1 represent the stock price at time T less 1, okay, or T minus 1. So the first term, RT represent the return on holding stocks, okay. So RT equals PT less PT minus 1 divided by PT minus 1. So the first term on the right hand side, the first term represent capital gains, okay. PT less PT minus 1 divided by PT minus 1 represent capital gains over time, okay, on holding stocks. And the second term on the right hand side is DT divided by PT minus 1. Okay, this term represents return on dividend over time, return from dividend over time. Okay, so here how to calculate the actual return on holding common stocks? As you can see, RT equals PT less PT minus 1 divided by PT minus 1 plus DT divided by PT minus 1. So the actual return on holding stocks come from two parts. The first part is capital gain, maybe capital loss. If PT is greater than PT minus 1, that represents if you hold stock during a time period, you will gain, you will have the capital gains. Otherwise, you will face capital loss, right? It depends, right? And the second one, during a time period, you will have the dividend from holding stocks, right? So you will have the dividend rate or rate of return on holding stocks. You will gain the dividend, okay? So here, the formula can help us to understand how to calculate the actual return on holding common stock. And if you stockholder holding the common stock, they have on the right. The right I would like to introduce is the residual claim. What is residual claim? Residual claim means if the enterprise faces bankruptcy or they shut down the company or shut down the enterprise. So we believe the company will have the residual value, right? So for common stockholders, they have the lowest priority claim in the event of bankruptcy. They have the residual claim. We call the residual claim. But the residual claim, their priority on holding stocks on residual claim will behind the debtor or creditor, even preference stockholders. Why? Because when the corporation enterprise face the bankruptcy, right? Their residual claim, the first priority is the creditor. Okay, so the senior claim may be the payments owed to creditors, such as the firm's employees, bondholders, the government. So after the residual value of the enterprise, they pay the payments for creditors. Maybe he pay the payment for their employees, bondholders, and the government, the taxes for government, right? And even preference stocks, parent stockholders, the residual claim will owned by common holders. Okay, so the residual claim feature is associated with the common stock markets. It riskier than the bonds as investable assets. So that's why in this slide I want to show you actually the common stockholders also own the residual claim, but they own the lowest priority claim in the event of bankruptcy. And the second feature on holding common stock, I would like to introduce the limited liability. Limited liability implies the common stockholder losses are limited to the amount of their original investment in the firm. Okay, initially maybe the stockholders they spend their money or invest their money on buying stocks, right? If the company or the enterprise faces bankruptcy, okay, or they make a serious loss, okay, they own the credit a lot of money, But for stockholders, don't worry. The limited liability represent the common stockholders' losses are limited to their amount of their original investment in the firm. If the company asset value falls to less the value of the debt. Okay. So here the second feature on holding common stock is limited liability. And then the next one, the third feature on holding common stock I would like to show you is the voting right. Voting rights. Common stockholders controls the firm's activities indirectly by exercising their voting rights in the election of board of directors. So for every common stocks, they have the voting right to select the board of directors, right? In director to control the company, the right on holding company, right? So typical voting rights arrangements is to assign 1 vote per share of common stock. Some firms organize the dual class firms, where 2 classes of common stocks are outstanding, and with different voting auditor and all dividend rights for each class. That represent some enterprises, they will set up different dual class firms, so they have different voting rights on selecting board of directors. And here I also show you the proxy votes. If your common stocks recently, maybe due to COVID-19 pandemic or other issues, because every quarter on the US, every quarter they will hold the board meeting, right? Or in Taiwan is every year. But unfortunately, maybe in the meeting, some stockholders will not attend the meeting, but they want to select the board of directors. How could they do that? So here, some companies will provide a way to protect their voting rights. This way we call proxy votes. Most shareholders do not attend annual meetings, annual board meetings, right? Or due to COVID-19 pandemic, they will not attend the physical annual meetings. Maybe they will hold the online annual meetings, right? Or they will not attend to the annual meetings. But some enterprises will provide a new way, let shareholders can attend board meeting or annual meetings. This way we call proxy votes. A proxy is a voting bailout sent by a corporation to its stockholders. Okay, so by using the proxy votes, they can select the board of directors by online or through the internet. By 2010s, virtually all the US firms are putting proxy statements online and allow votes to be cast via the internet. Okay, it's a very popular trend for the enterprises. And compared to the common stock, here I would like to introduce the preference stock. Preference stock, actually the preference stock is a hybrid security that has characteristics of both bonds and the common stocks. Or you can say it's a mix. It's a mixed financial instrument. Why? Or hybrid security? Because they have the very important feature. Similar to the common stock, in that it represents an ownership interest in the issuing firm. But like a bond, it pays a fixed periodic dividend payments, right? So the stockholder, if they hold the preference stock, actually they will gain they will share the profit from the company, from the enterprises, but the dividend is fixed, just like the bonds, right? As we know, the bonds payment, a coupon for the bond is fixed, right? So that's why we call the preference stock is a hybrid security. And the dividends on holding preference stock are generally fixed, pay quarterly. In Taiwan, we pay annually, okay? And the preference stockholders generally do not have the voting rights. So here I show you the disadvantage on holding preference stock. Advantage on holding preference stock is no matter dividend policy every year or every quarter, they will have their own fixed dividend every quarter or every year, right? But preference stockholders generally do not have voting rights in the firm, but more stocks may be converted to common stock at any time or under investor choices, right? Depends on their preference stock setting, default setting. Typically, the preference stock is non-participating and cumulative. So here I want to show you the important feature on preference stocks. Okay, so actually we can break down preference stock into types. The first type we call non-participating preference stock. The other one we call participating preference stock. Non-participating preference stock means the dividend is fixed regardless of any increase or decrease in the issuing firm profit. But participating preference stock means the actual dividends paid in any year may be greater than promised dividends. That means if the stockholders they hold participating preference stock, they can gain the fixed dividend according to their dividend policy, right? And on the other hand, they also can join the dividend pays each quarter. If they earn, the company own lots of money, earn lots of profit, the participating preference stockholder, they can join the dividend sharing. Okay, and on the other hand, here we also can break down the preference stock, the type of preference stock into parts. The first one we call cumulative preference stock and the non-cumulative preference stock. Cumulative preference stock means that any missed dividend payments go into arrear and must be made up before any common stock dividends can be paid. While dividends of non-cumulative preference stocks do not go into arrears and are never paid. But usually, most preference stock belong to the cumulative preference stock. Eventually, the company, the enterprises, face losses or earn zero profit this year. The preference stockholder will not gain dividend this year, right, or this quarter. But next quarter or next year, the company's enterprise will make up the dividends you miss. Okay, so we call the cumulative preference stock. In this slide, I would like to show you primary stock markets and the secondary prime markets. Okay, so what are primary stock markets? As you can see, here I show you the definition of primary stock markets. Primary stock markets are markets in which corporations raise funds through new issue of stocks. Okay, that means if the corporation or the enterprise, the company, go to the financial market, this first time to release the stocks to their stockholders or investors. This way, this phenomenon we call IPO. The company go to IPO, right? IPO represent initially public offerings, right? That means the company, the enterprise, issue their stocks first time in the stock market, right? So, and the stock market we call primary stock markets. And how could they issue stock market to their investors? Usually in the US, they will go through the primary stock market by investment bank. Okay, so the most primary stock market transactions go through investment banks. Investment bank can conduct primary sales using either firm's commitment or best efforts underwriting basis. Okay, I will show you the diagram later. Okay, maybe we should look at the diagram. In this diagram, I would like to show you how the primary stock transaction works. Okay, so as you can see, the company go to the financial market, issue their first time stocks to stockholders or investors. They will go through the investment banks, right? Investment banks play a very important role on the primary market stock transaction. Okay, so as you can see, the issuing corporation issue stocks through the investment bank. Investment bank have the two ways to issue stock to stockholders or investors. The first way we call commitment sale. The second way we call best effort sale. Commitment sales, let's back to the previous slide. Commitment sales or commitment writing, they represent if firm commitment writing, the investment bank guarantees the corporation a price for their newly issued securities. Compared to the commitment writing, best efforts underwriting occurs when the underwriter does not guarantee a price to the issuer. Okay, so here I show you the investment bank will provide two ways to issue stocks to investors. Okay, now through the diagram, you will understand how the primary market stock transaction works, right? Issuing corporation or insuring firms issue the stocks through the investment bank, sell stocks to their investors, and then raising funds from investors to issuing bank, even to funds flow into the issuing corporation. So, in addition, a syndicate, if the issuer company, the company issue lots of the stocks to their stockholders or investors, maybe they will need a large group of investment bank. Okay, the large group of investment bank we call syndicate. A syndicate is a group of investment bank working in a concert to sell and distribute a new issue. But the lead banks are the syndicate, is the originating houses, originating house. In the primary stock markets, it's the first time the company issues the stocks to investors through the investment bank. The process, the procedure, the process we call IPO. I mentioned before, right? Initial public offerings. So IPO is the first public issue of the financial instrument by a firm. And in addition to the IPO, if the firm want to raise money again, they want to issue the others stocks to investors in order to raise more money. The procedure or the process we call the seasonal offering. The seasonal offering is the sale of additional securities by a firm whose securities are currently and publicly traded. If you are original stockholders, if the issuing firm issue another shares or stocks to new stockholders or new investors, actually original stockholder, they have the right, ability to maintain the proportional ownership. The right we call preemptive rights. Preemptive rights represent the original stockholders. They have the ability to buy the additional securities to maintain their proportional ownership. Okay, and here I also show you the registration of stock can be a lengthy process. Here we have two types of registration of stocks. The first one we call a red herring prospectus. A red herring prospectus is the primary version of the prospectus that describe a new security issue. And compared to a red herring prospectus, here we have shelf registration allows firms that plan to offer multiple issues of stock over 2-year period and submit one registration statement. Okay. And compared to the primary stock markets, here we have secondary stock markets. Secondary stock markets are the markets in which the stock one issued are traded by investors. When the insurance firm issue the stocks to stockholders, right? And the stockholder can sell their stock to other investors through the secondary stock markets, right? So here we call the stock exchanges. In the stock market, market value or the total value of the stock markets, over 90% market shares belong to the stock exchanges or secondary stock markets transactions. Okay, so in the secondary market transactions, funds are exchanged, usually with the help of the security broker or firm acting as an intermediate between the buyers and the sellers of the stock market. Okay, and the original issuer of stocks is not involved to transfer all the stock or funds. Okay, so here I would like to introduce two major U.S. stock markets. The first one, the most important and the famous the stock market in the U.S. As we know is NYSE, Euronext. NYSE represents New York Stock Exchange, Euronext. Okay, and the other one is also very famous in the stock market. We call NASDAQ system. NASDAQ represents National Association of Security Dealers Automated Quotation System. Here in this slide, I would like to introduce the NYSE. Worldwide, the NYSE Euronext is the most well-known of all organized exchanges. The exchange was created by the merge of the NYSE group. The NYSE group merged Euronext in 2007. That's why we call NYSE Euronext. And the world leader for listing, trading, cash equities, or equity interest rate derivatives, or bonds, and the distribution of the market data. Okay, so it's very famous the stock exchange in the world. Or I should say the most famous stock exchange in the world is the NYSE Euronext.